Hey, good morning, guys. Thanks for dialing in. Always appreciate those of you that do call in. I know it's busy time of year, so most people are watching it on video. So I've clicked the mute button to keep it quiet in the background. If you've got any questions, text me uh, or use the chat function, and I'll do my best to get them answered. And we'll just kind of jump right into it. First of all, let's go through what's kind of unfolding from a macro picture. I think it's important to just kind of keep in mind the things that are happening in the backdrop, and then we'll see those things unfold in the technicals. And remember, the chart action, each daily bar is the trader's reaction to what is unfolding in the marketplace. So, as bullish things unfold, we see money start to flow into commodities. As bearish things unfold, you start to see people panic and start selling. So, let's take a quick look at what is happening in the macro picture. All right. First of all, in our crop, from the 2020 crop, what we have is not a record. The USDA originally said that we would have a record, and now we don't. So you have this domestic crop that is smaller than what was once portrayed, and you've seen that as the acreage number has come down, and you've seen that as the yield number has trickled lower in the USDA reports. So number one, our crop isn't as big as what was originally forecasted. Number two, earlier this year, China's couple things happened in China that uh, that the market was skeptical of in the to begin with. And that those China developments really started about 3 years ago. 3 years ago, China just all of a sudden one day updated its domestic supply numbers and found magically 6 billion bushels of extra corn laying around. And at the time, the traders here in the U.S. said, we're going to call BS on that. That's not real. But we traded as if it was. What happened this year is China's crop got into trouble. In the north, they got into a drought and they had some insect issues. In the south, they had flooding. So their domestic crop shrunk. And all of a sudden, China came out and said, oh, we don't have 6 billion bushels of corn laying around in storage. So 3 years later, we find out that the communist country lies about its balance sheet. Big shock, right? So, our market has said, oh, I guess that might be a little bit bullish that China doesn't have any corn domestically. We saw that unfold in the Chinese futures market when the Dalian futures started the rally and eventually has hit $10. So you've got China trading at $10 because it doesn't have any corn. You now have the US market saying we still have some, so we don't need to rally a whole lot, but our crop is getting smaller. So what that does is create this competition, right? It says, all right, we've got supply. We need to be competitive with everybody else because if China's going to buy, we want them to come to us. So we've held our futures in the corn market at a discount to South America. South America is trading at $8 corn. China's trading at $10 corn. We're trading at $4.50 corn. So we've held at a discount and we're vying for that business coming from China. Well, enter La Nina and enter the South American weather picture. What South America did early on in this trade war that is going on with China is they sold China all of our beans. Our dollar was strong, their currency was weak. China went to them and bought them, and they literally bought them out. They bought so many beans from Brazil. The Brazilian domestic users are having to import beans from other places because they sold them all to China. And China did that to manipulate our market. So through June, July, and August, even though we had a trade war going on, or a phase one trade deal, China's buying as many beans as they can from South America and holding our price low. And now all of a sudden, our crop shrinks. Brazil's out, so they've rushed to our market to buy them. South America starts to plant its new crop and now enter a La Nina weather pattern where they're at historically really dry weather. So remember, number one, we said our crop was smaller than we originally thought. Number two, China has less supply than we originally thought. Number three, our currency was strong during the summer, so they bought them all from Brazil and ran Brazil out, banking that Brazil would have better supply. And they were wrong because La Nina is coming in and jeopardizing that supply picture in China or in Brazil. So you've got this perfect storm brewing where China's out of corn, Brazil's out of corn, Brazil's new crop is on the ropes, to put it mildly, and we've got this new factor here, which is a new a transfer of power in the U.S. to a new domestic policy where we're just going to keep printing money. That devalues our dollar. So when our dollar starts to devalue, that is inflationary. You've got this perfect storm of low supply and inflationary tendencies that's just going to pull money into the marketplace. Now, Elaine Cubb put out an article this morning on DTN, and I'll try to find a link to it and send it to you. But it was a really good article about money flow, and it was her point in this article was that the reason investors are flooding to soybeans and why we haven't peaked yet is because higher prices beget higher prices. If you have an $8 commodity and it moves 1%, you've moved 8 cents. If you have a $12 commodity and you move 1%, you move 12. You move 50% more for the same percentage move. That attracts more dollars because they get bigger bang for their buck. So higher prices generate higher prices just in more wild swings because that's what the traders want. So you're starting to see that in soybeans as we start to get into these higher digits. That's why our daily ranges are expanding. And you can, I expect and think that corn will follow that because of this situation that we have brewing, right? Because our crop is smaller than it was. The global supply situation is lower than it has historically been. And our currency is getting weaker. That makes us more attractive. And ultimately, corn has to buy acres from beans, and it can't just sit back and give them up because we've got to compete for acreage. So as corn starts to tick higher and that percentage move gets to get more bang for its buck, you're going to see that start to self-reinforce as well. So it's not as simple as the funds are too long versus where they were in 08 or 012 or 15. That's not how they think about it. They're trying to put dollars to work, and in my opinion, 2021 is very different than 2008, 10, and 12 because our money supply has increased exponentially. So they have so many more dollars put to work. You know, if you're a fund and you have 10,000 contracts put to work in the corn market in 2008, and that was and you're managing $10 billion. Well, today you're probably managing $30 billion. So you need to put 30,000 corn contracts to work to have the same impact on your balance sheet. It's the self-reinforcing deal. So I don't think that the Commitment of Traders report is nearly as relevant in this market as it has been historically. That's my opinion. Take it for what it's worth. But I think with this setup, we're starting to see things that are historically significant, and we're seeing that in the technicals. Okay, Enough of my that's just how I see the world from a fundamental standpoint, okay? And the technicals are reinforcing that. This is the daily chart of soybeans. We've got a nice uptrend. There's absolutely no threat to it. There's no end in sight to this market moving up. There's no sell signals on here. We had some in here. This looked like it was beginning to correct. The market chomped right through it, and it's gone total parabolic. This is indicating that we very well could see at least another 2 to 3 weeks of significant upside. Yesterday we had a gap. There is a 1/4 cent gap. The high of yesterday was Tuesday. The high of Monday was 11.55 1/4, and yesterday's low was 56 1/4. So you have a 1 cent gap right here. What do we know about gaps? We know that there's 3 kinds. You have a breakaway gap, which happened right down here. See this gap right there? That was a breakaway. You have an exhaustion gap, which happens at the end of a trend, and you have a midway gap or a measuring gap, which happens in the middle of a trend. This gap could be a measuring gap, which counts all the way. It doubles this move from 873 to 854, which is $3. You would put $3 from this point on here, which takes you to 1450. If that's a measuring gap, then that's where we're headed. Now, I don't think we'll go straight there in a parabolic fashion. We surely will get some sort of a pullback and some sort of a sell signal. But if that's what that is, then that's the target. If it's an exhaustion gap, then we're going to start to see reversal action very soon, and we're going to ultimately take that low out, fill the gap, take that low out, and we'll be on pause for a few minutes. Now, let's look at the weekly chart and see what's the most likely. Here's our weekly chart of beans. We don't have a gap on here, but remember, we've been talking about this for weeks, comparing this move to 2016. And we've said in 2016 that once we broke 1050, we accelerated and we moved radically higher. We identified this pre-trade war level at 1080 as critical. And you can see we challenged it for about a month. We've broken it and we accelerated straight up, and we've been talking for weeks that if this 1080 level breaks, $12 is a target. So it looks like we could hit that today, because we're just chomping through things on big volume, and we're not taking any breaks. So we could easily see $12 today or tomorrow. Nothing should surprise you here. What we're looking at is this high, which is 1208, 1209. If we chomp up to 1209, blow through it and hold it, then the odds become much greater that this is a measuring gap and that signals much higher prices. So kind of this next 30 cents here is really critical to determine the next few weeks or months of bean movement. So the question is do the fundamentals support it? Well, guys, we just went through it, right? The dollar's getting cheaper. The supply, the weather situation in Brazil is dire, and it's very important that our beans or that our market generate new beans for the new crop supply. So there's a very real possibility that we could just move on higher. Now, I found a graphic that I think is important for us to have in the back of our mind. There's a gentleman named Philip Luce. I've never met him. I have no idea who he is, but he posted this on Twitter. So my opinion is if you post a graph on Twitter, you want us to use it. So I borrowed it from this guy, and I want to make sure I give him credit. But I think this is really good. This is a picture of where each of the months of soybeans are trading. And we have this huge inverse. So we're currently trading nearby January beans at $1.30, almost $1.30 inverse to next November. So he's got it adequately right. I can't say it any better. The market's not sure if we have enough beans to survive to new crop, and then we think we've got plenty. That's exactly how the market is currently structured. And there is a lot of people that have this belief that in this setup, a lot of times this is your best sale. So if we do have a new and I think what the market's waiting on is they're waiting on confirmation that South America's new crop isn't going to be huge. And if they don't have a record crop and replenish their supply to compete with us, then I think you see this November contract explode, because it's going to come up to where we are. If they grow the crop and they have plenty of bushels, then the market structure is going to look just like this, because we don't need a premium on that new crop, right? Makes sense. If there's plenty of supply, we don't need to go screaming to buy acres. If there's not enough supply and the world's out of soybeans, then we're going to get stupid and we're going to go crazy high because we've got to buy the acres. All right, that's enough of soybeans. But that, sorry to hammer 15 minutes on beans here this morning, but it's where all the action appears to be. Okay, let's look at corn where we're at. Let me get this to March corn. All right, here's March corn. It really hasn't engaged with beans, right? You saw that parabolic move in beans. Corn hasn't followed it. And I'm going to preface that with yet. Corn's in a little different situation because we still have plenty of it. Even with a 1.7, 1.8 billion bushel carryout, we're not short corn in this country. That's plenty. And if we continue to hit trend line yields, then odds are we'll still have plenty of corn. But if the La Nina pattern continues, then corn can change really quickly, because if South America doesn't have good crops and we're dry going into our weather season, then we keep putting more premium on here. Or if beans explode and continue higher, then corn's got to go with it because it's competing for acreage. And my eye is completely focused on the US dollar. If that dollar continues to break and get lower, then that is a very bullish catalyst for corn and something that should not be ignored. So today, corn really doesn't look that great. And certainly the fact that it's not following beans on this last March higher is not overwhelmingly good. But I don't think it's bearish, because I just don't see a ton of new supply coming on. I just think corn is on pause here, waiting to decide if it really needs to engage and go buy acres or not. So we could be range bound here nearby in corn for a little while, but I don't think that we're going to turn around and go close this gap, for instance. If something were to materialize in the corn market, in the next few days, we could see a gap up here, and that could be a measuring gap from here as well. So don't rule corn out yet, and I wouldn't take any drastic changes on next year's marketing. I just sit and wait, because we need to see how this market's going to react. Same with wheat. I got 1 minute here, but don't sleep on wheat here either. We've chopped sideways. We've consolidated. A lot of times consolidation favors continuation, not reversal, guys. Wheat could explode up out of here and blow right through $6. And certainly if beans take out 12.10 and corn starts to turn a corner, I would expect wheat to go with it, and post a new leg higher here. So I'd be very patient with wheat. I just don't see the downside being real extreme in this current environment. It's always subject to change, and for certain, and this is the last thing I'm going to say, if we shut the country down, and we're not burning any petroleum, and we don't need ethanol, and we kill our ethanol plants, then everything I said about acreage battles and upside momentum is dead, gone, and we're going lower because that would just be catastrophic to corn. Because remember, that's 6.5 billion bushels that go into ethanol. So we have to have we got to be burning gasoline to keep corn high, especially in this market. So with that, I'll leave you. We're bullish unless we shut the country down, and then we're worried. I think that's the best way to put it. And we'll see how it goes. If you've got questions, please call me. Remember, there is tremendous risk in trading futures, and there's no sure thing in any way, shape, or form. So please be careful and think through any decision before you make it. Make sure you can afford it. Have a great day, and I will talk to you next week.